So good news is the situation was avoided. The implications were, what sort of happened in the aftermath in the second half of 2009 is the banks that basically borrowed the money inexpensively from the government and got this huge infusion. They showed tremendous profits and tremendous returns because a lot of them, by virtue of this TARP fund, were buying these assets at 50 cents on the dollar. And what happened is these assets began to, creep up to be worth 80 cents on the dollar, okay? Because there were more buyers in the market. And when this happens, they had huge, huge profits. I mean, Goldman Sachs had the most profitable year they've ever had by virtue of utilizing the TARP funds to go buy troubled assets at discounted prices and let the market come back. So it bolstered the balance sheets of all these different investment banks. They're stronger and healthier, and the majority of the people who borrowed money have repaid the borrowings back to the government. And they're also, in the effort to, they're trying to accelerate the repayment back to the government, and they're also telling the government, don't tell us what to do anymore. We don't want you regulating us. We don't want you to determine our compensation. We don't want you to infuse any will into our business. And I think the government's like, not so fast. We are going to increase regulation. So the next chapter you'll be reading about in the upcoming months is more financial regulation to sort of mitigate a series of these problems. So that's my view on sort of the financial collapse. I think it's a very fascinating period that really we sustained a major traumatic event. And it was really around performing triage on the weekend of September 15th that had AIG failed, all bets are off. So interesting period. You will probably be reading about this for a long time. Not sure the economic stimulus package, a lot of things they're trying to do out of Washington haven't quite caught haven't got the momentum back into the market yet. But I do think we're into maybe a little more stable interest rate environment. And I think you're going to see interest rates are very, very low now. I think you're going to see Bernanke sort of slowly creep those up over the next 2 to 3 years of the next term. So that's my story. I can answer questions or.
Sure. Is AIG expected to pay back that $400 billion?
AIG, they are expected to pay that back. It was government made it in the form of an investment, so government owns like 95% of AIG now, or 99%. How they go about media, I think they defaulted on these. They ultimately defaulted on these credit default swaps to a large degree. The government helped them pay off some of them. So AIG will be around. Unfortunately, AIG does a lot of great things. Say they've got 50 lines of business. The CDO business, which is one of 50 lines of businesses, not only took AIG down, but could have collapsed the whole financial system. And that's why people didn't really understand this. No one fairly priced the risk of owning this bond because they thought they were safe. They had insurance, but they really didn't have insurance. Because when everything failed, AIG couldn't pay the client. How many of you have seniors? Go ahead.
Well, I was just wondering, that 8% default rate, how much higher is that than the regular, normal mortgage?
These are more what I would put. These became into what are called the subprime category. So prime mortgages are the sort of best payers. The subprime market tends to be a lower quality payer. So I saw one default rate One of the numbers I saw was, here's one other data point. In 2004, you took 2004 out here, 10% of the mortgages were to subprime or lower quality borrowers. In 2006, 25% were to low quality buyers. And this is when they got more aggressive on the lending standards, is when the problem really occurred. The lending to subprime borrowers. Subprime borrowers are lower credit quality. And not only were they borrowing against their house, but credit card companies and other car leasing, a lot of people were lending money at very attractive rates. In 2000, the Fed funds rate, the rate that banks lend to each other, was in 2000 it was 6.5%. In 2003, it was 1%. So that post the 9/11 problems and the dot-com crash, the Fed policy under Greenspan decided to lower rates very dramatically from 6.5 to 1%. And in doing that, it spurred inexpensive borrowing. So the whole sort of engine of financial innovation kicked in, and that's really what caused, I think, the nature of these problems. How many are seniors here? Okay, all the guys have to go to the lot tonight. All right, that's what I'd like to see. Who's going to the funnest place at spring break? Who's got the best trip planned?
I'm going to Denver, Colorado.
Denver, all right.
I'm too. Me too.
Skiing or just
Yeah, this other thing.
snowboarding? Are they going to Florida? Florida.
Yeah.
St. Pete. Good. Who's sticking around? Studying? Catching up? Any event, you'll read about this whole phenomenon in the economics books will cover this period. It's going to be a very interesting time. And if you read one magazine every week, read The Economist. I think they do the best job explaining what's going on around the world on the financial side. And glad to help you guys out.